Hey everyone, in this video we're going to talk about 20 US dividend paying stocks. Now before getting into it, if you like this type of content, please subscribe to the channel, hit that like button, it really does help the channel a lot. And if you own any of these stocks, I'd love to hear from you in the comments as well. Now, the objective of this video is hopefully, while you may know lots of these companies, you discover one or two that you didn't know is publicly traded or you didn't know paid a dividend, and maybe you go do some more research on your own or add it to your watch list. And that's why I've compiled a large list of 20 to hopefully hit that for everyone. And we're going to start at the lowest paying dividend stock that I have on the list and go all the way to the highest one. So, stock number one is Microsoft. Microsoft, as you all know, or most of you likely know, owns Microsoft 365. So, businesses like Excel, Microsoft Office, PowerPoint, and they sell that to lots of businesses and individuals for recurring revenue streams. But they also own Azure, which is the second largest cloud company behind Amazon Web Services, along with Xbox and LinkedIn and many other endeavors that they're kind of diversified in. So, primarily a software company, high level of diversity or diversification rather in their revenue streams. And they've been growing really nicely, having a larger lot of margin expansion over the medium term. So it does trade at a pretty rich valuation, 28 times, but in my opinion, it's deserved that value. It's paying a 1% dividend, just increased it 10% a few months ago, and has been increasing it kind of 10 to 20% annually over the last 5 years. So not a high starting yield, but one that you can consider to build yield on cost over time. Now we're going to move pretty quick because we have a lot of companies to get through. Stock number two is Hershey. So Hershey goes without saying is a chocolate company primarily, but they also have been expanding and investing and expanding into other segments of snacking. They own some popcorn businesses, lots of pretzel businesses, other snacking companies that they've purchased, but primarily they own businesses like obviously Hershey, but then Reese's, O. Henry, Kit Kat, etc. So really big chocolate business, confectionery business, and they've just been growing very nicely over the last year, but also past 5 years, up almost 150%. So similar to Microsoft, pretty small dividend, under 2%, but they do grow it as they've been growing their business. Stock number three at about a 2% dividend is Intel. So obviously one of the largest chip companies in the world. They've had a really tough year. I'm not in this space too much, but I think overall chips have had production issues, have been commoditized to a certain extent. So don't know too much about Intel, but it does pay 2% dividend. It always trades at a good PE. I think it used to be under 10 when the price was higher. So it's just a bit of an earnings trap when you look trailing PE. You really have to look at forward forecasts as a watch out if you have this on your watch list. But that's the third stock on the list with a 2% dividend yield. Going into the fourth stock, it is Starbucks. So Starbucks pays just north of 2% dividend yield. This stock's gone on a bit of a wild ride over the last couple years. Was up at 120, went down almost 50%, down into the low 70s, and now has skyrocketed back up to over 100. So at over $100, at $120 billion market cap, I think this is pretty richly valued in my opinion. I'm staying away from it. But definitely an interesting business, remarkable business that's scaled up very well. It's just a matter of valuation that's pretty high. But for those of you who are in it for the long haul, love Starbucks, love their business, you will get over 2% starting yield. And similar to some of the other companies we talk, like Hershey, they do tend to grow it over time. Going into stock number five, Target. So Target, now we're getting into a bit juicier dividend yield territory. Target pays about a 2.65% dividend, $75 billion market cap. And I believe their earnings forecast for next year is around $13 to $14 a share. So this one is trading, that actually seems too light. Too heavy. So I need to check up on that, dismiss that comment. But nonetheless, 2.7% dividend. The stock's been down over the last year as lots of retailers, especially those who rely on discretionary sales have had some issues as consumers have kind of pulled back with inflation and focused more on staples and experiences than anything else. Stock number 6, PepsiCo. PepsiCo's been a fantastic company to own over the last number of years, despite the pandemic, inflation, everything else going on. You just see them consistently kind of growing and bouncing back from headwinds on their business, trading pretty close to an all-time high, about 6-7% off of it. Consistently has been paying a 2 to 3% dividend and has been growing it at about 10% a year. So this has been a great business to own. It does trade at a bit of an expensive valuation, but when you are buying premium companies who can kind of weather all kinds of storms and remain profitable, you're going to have to pay that multiple. So don't currently own this one, but I think it's a great business, and any dividend investor should consider looking into PepsiCo more. J&J, going into stock number 7 here. J&J pays almost a 3% dividend, a leader in healthcare, down almost 10% over the last year. Year to date has really suffered, so maybe they had a bad earnings report. But this company is spinning off their consumer products business, which should free up a lot of cash and unlever their balance sheet, and trying to be more solely on medical products, medical devices, as well as pharmaceuticals. So it will be really interesting to see the direction this company goes over the next couple of years. But this has been a company who's increased their dividend for 50 years or so. So you're getting a 3% starting yield, but high conviction that that'll build over time. Home Depot, similar to J&J, about a 3% starting yield, trades at a 17 price to earnings, a bit more volatile on this one just because of its reliance on people doing home renovations, new home builds, stuff like that. So it's kind of traded, it's crashed from the highs when everyone is upgrading their homes, and it's kind of traded sideways here for the last 15 months or so. So interesting entry point if you think it's going to break out again, but if you think the economy has more room to go down, this one will disproportionately get hit, so you may have a better buy-in opportunity. Moving on to the next one, JP Morgan Chase. So JP Morgan Chase, obviously a big US bank, pays almost 3% as well, and this is a stock that over the last number of years has had a bit of a roller coaster as well. Went down to 90 during the pandemic, then all the way up to 170, so it almost doubled, back down to 100, and now has rallied up to 140. I'm actually surprised to see them have such a strong rally in recent months, but nonetheless, trading at about 11 price to earnings, 3% dividend yield. So this could be a good option for a dividend investor looking for more exposure in the financial space. Going on to stock number 11, Omnicom Group. So lots of you guys may have not heard of this company, but this is actually one of the largest media agency conglomerates in the world. So they own lots of media agencies under different brands that provide a variety of different services to advertisers. Trades at 14 to 15 price to earnings, pays out a 3% dividend yield. And this is another one that really is tied into the macro economy. Really depends how much advertisers are looking to spend. And I think they have a lot of their business in like TV advertising, even though they do have digital agencies and stuff like that. That'll just be a big pivot over the next couple of years for them as more money flows to those other channels. And do they have more kind of new world competition that they previously didn't have to deal with in those digital, more nimble spaces of ad spend. So that'll be something interesting, but you aren't paying a huge PE for it if you did want to take the chance on it. So this could be an interesting one to diversify your dividend income. Going on to stock number 12, it is Clorox. So Clorox, obviously a consumer products company. They own Clorox, but they also own a number of different brands like Burt's Bees and a couple other outdoor brands, as well as Brita filters, on and on. They are paying a starting yield of 3.1%. They have also come down quite a bit from the pandemic. They went all the way up to 240 as everyone was buying Clorox wipes, stuff like that. And now they've also been trading sideways over the last year or so. So over 3% starting yield. I'm not sure what their true PE is, but this is a stable company over time. I know they've gone through some wild fluctuations given what's happened in the world over the last couple of years. But over time, before all of that happened, this was a company that was trucking along, delivering a lot of organic growth year over year, has lots of products that are better for sustainability, better for the world. So kind of riding that trend and tailwind as well. We'll see if they can kind of bounce back to their old ways of the 2010s that you can kind of see here, going from um, essentially doubling the stock from 65 to 150 there. Okay, going into the next stock today, Comcast. Comcast is an interesting stock. You've seen it down 22% over the last year, down over the past 5 years even, before taking the dividend into account. But they do pay a decent 3.2% starting yield. Comcast is in my opinion, in a bit of a tough spot. Part of their business is cable, which with cord cutting, even though they do have lots of premium cable, like CNBC for those that are involved in business and stuff like that, but lots of other really core cable and news networks that they own. But as just secular decline happens in that industry, they're not very well positioned for the next leg of media, in my opinion, with Peacock being of relatively poor service and not really having a strong streaming play. I think they may get left behind in media, or at least lose share. And then on the other side of their business, with like internet services and stuff, that's just a very capital intensive, brutal space. Lots of competition. T-Mobile, Verizon, AT&T. It's just an absolute war. So they're in two spaces that require a lot of capital, and over the last number of years, low returns on invested capital, and you're kind of seeing that flow through into the share price here, past 5 years as well as past 1 year. So I think this PE is wrong. I think they trade closer to like a low to mid teens, but for that relatively good price to earnings ratio on a very old proven company, you do have to acknowledge that they are in a tough spot and playing in categories that have a lot of competition right now. Okay, moving on to Chevron. So Chevron is obviously an oil and gas company trading at a pretty low PE, pays about a 3.7% dividend yield. But this is one that obviously is cyclical as the price and demand for oil and gas go up and down. So this can be a very different story next month, next quarter, next year. And if you think gas and oil is gonna continue to stay where it is now or go up, this could be a good buy. You could be getting a good PE and cashing in dividends along the way. But if things go sideways or downwards, you could get really hit in this one. So a bit more of a risky one in my opinion. But if you're looking for a bit of risk in the oil and gas space, this wouldn't be a bad one to put on your watch list. Stanley Black & Decker. So Stanley Black & Decker, paying about a 3.8% dividend yield, is the world's largest tool company. So they own brands like DeWalt and stuff like that. They've gotten hit in the last year. So down 44%, has really created a pretty nice dividend opportunity for long-term shareholders if you believe in their business and the segments they play in, at over 3.8%. If you look past 5 years on this one, you can kind of see during COVID, similar to Home Depot, where when people were doing more renovations and stuff like this, the name actually went to $216. Wow. So really down 60% from their all-time highs there. So is there going to be a rebound? They're trading cheaper than they were before COVID. So not overly close to the competitive atmosphere or the macroeconomic impact on their business, but an interesting big name company with great market share, giving a 3.8% dividend. So one to potentially look more at as well. Wendy's, I just did a full stock analysis and business overview of Wendy's stock for those of you interested in it on my channel. They just doubled their dividend to 4.6%. It looks like that's going to be more than they earn next year. So really interesting move there. So that's my only risk on this one. It is a great dividend, great brand, but they may be getting a bit ahead of themselves in terms of how they're allocating their capital. And I'll leave it at that. For those of you who want to know more about the company and my opinion on it, you can go to my channel and watch that video separately. VICI Properties. So VICI owns a lot of entertainment properties across the U.S. Their primary assets are owning the hotels in Vegas. So I think they own like the Venetian, and they're buying up the whole strip pretty much. But they've done phenomenally well. Past 1 year, they've paid about a 5% dividend, give or take, up 25%. So collectively, you've gotten 30% back as a shareholder in a year that the market's been down 10 to 15%. So it's outperformed the market like 40 to 50 points. So remarkable. Congratulations to anyone who's owned VICI over the last year. But even looking forward, they continue to grow. They have inflation-adjusted leases. They're paying out a 4.7% dividend yield. So not a bad option to park some money and potentially, obviously, do your own research. But looking forward, if you're just looking for a bit of an inflation hedge, a dividend along the way as you like evaluate the company or evaluate alternatives, not a bad proposition for investors here, in my opinion. And sticking on the real estate trend, the next stock is Realty Income Corp, paying a slightly higher 4.8% dividend. Realty Income Corp owns a lot of triple net leases, think all kinds of retail space across the United States. They're really well diversified. They really play everywhere, and they do pay a nice 4.8% yield. This has been plagued to be the monthly dividend company because they do pay on a monthly basis, which is nice for some investors as well. So for anyone looking for retail exposure and real estate exposure in their portfolio, this is kind of the go-to stock for that, and they do pay a pretty nice distribution. Okay, going on to stock 17, I believe. IBM. So IBM pays over a 5% dividend. Obviously, old school company, really trying to migrate to the cloud, has made a couple acquisitions, has actually performed much better than lots of the other tech companies, up 2% over the last year. That's because their valuation kind of never got as expanded. This PE is not right. But even as we look at Microsoft, which is like a best-in-class tech company, in the last year, they're almost down 10%. Little old IBM has outperformed them significantly, being up while paying a higher dividend. So this is one that you can do some more research on, but is paying a really healthy starting yield of 5% if they're able to figure it out and maintain that and hopefully grow it in the future. Okay, stock number 18, Walgreens. So Walgreens is paying a 5.6% dividend. It's had a really tough year. Lots of entrants into the health space in America. In addition to that, lots of challenges with retail right now. Obviously, consumers shying away from higher priced items. In addition to that, lots of theft in drugstores that they have to deal with and combat. So just lots of issues, more regulation going on in the pharmaceutical and over-the-counter space as well. So lots of things they're overcoming. With that being said, I think this stock trades at like an 8 price to earnings. So at some point, I feel like there's value here. It's just when's the right time to add it, or do you just not want exposure to a company like this in your portfolio? But it is paying out a 5.6% dividend yield, which is really nice, really healthy. And they do spit out a ton of profit currently still. So a lot of value to be had here. And it's gotten, wow, over the past 5 years down over 50%. So this company's really been through it. Going into stock 19, almost a 6% dividend, AT&T. So AT&T obviously has gone through a lot. over the last number of years, spitting off buying Discovery, buying Warner Brothers, buying DirecTV, buying Warner Brothers, selling Warner Brothers to Discovery, selling a stake in DirecTV, pivots all over the place, trying to reduce debt, et cetera, et cetera. They just haven't been managed overly well. But with all of that behind them, they're currently paying a 6% yield, trading at about an 8 forward PE. If I look at their free cash flow forecasts. So I just think this company's at a good value. I know they do have cable exposure, but they also have internet and other growing aspects to their telecom business. So I'll take a 6% dividend, as they also have money that's paying back debt as well. So I own this stock as a small position in my portfolio. Obviously do more research, but it's definitely one I want to highlight as a potential dividend option in the US stock market. And stock 20 of 20 is Altria Group. So Altria owns a lot of cigarette makers, cigarette brands like Marlboro and stuff like that, I believe, paying over an 8% dividend. They like to get all the cash out of the company, given regulatory hurdles and the government always coming after them. They don't want to be stuck with a lot of cash on hand. So don't expect too much growth, even though they do tend to grow the dividend. Just take that as bonus. You're getting an 8% yield just to hold the company. So once again, I'd be wary of making this a large position in my portfolio, but could be a good, company to hold just for the dividend income to invest in other things if you think that this business is going to be stable and demand for these types of products aren't going to deteriorate to a great extent. I don't know what their PE is because, once again, this looks way too high, but I would guess it's probably about a 10. So you're getting a pretty good PE on this name from what I directionally remember. And they have also gotten a hit over the last year or two. They keep trying to buy like e-cigarette companies. They messed up big time with Juul, paying way too much for it and then writing it all down. And I believe they just acquired a new one who's a bit more friendly with the government for $2.5 billion, so about 3% of their market cap. So we'll see how those things work out. But at the end of the day, their business is really just in cigarettes, and that's what they're profiting off of and spitting you dividend income back from. So these have been 20 stocks. Hopefully you found a couple in here that you weren't aware of before, or that kind of retweaked your interest in adding them to your watch list or doing more research. If you like this type of content, please subscribe to the channel. Let me know by liking the video. And if you own any of these stocks or have any opinions or experience with these companies, would love for you to let me know in the comments. I'll see you guys in the next one.